You are listening to Mining Stock Education.
So I recently got glasses for reading and for computer work. After staring at the screen for hours on end, I noticed that I was squinting too much, and then I would get a little bit of a headache as I'm straining the muscles around the eye too much. So finally humbled myself, went to the eye doctor. They did all the eye tests, came up with the prescription. It's a light prescription, but it does seem to help when I'm looking at the computer and reading books for hours on end. But before I ordered my glasses, the sales lady had me go outside. She gave me this test glasses, and she had me look across, and she said, "Look at the restaurant across the street. Can you read that? Does it seem more clear?" I said, "Yeah, it looks good." I said, "But I don't think I really need it for that. I don't feel like I have that big of a problem when it comes to long distance viewing." And then she said, "Okay, come back inside, sit here at the computer, stretch your arm out. Now put these on. How does that look?" Okay, that looks pretty good. But what I noticed was when I had the long distance glasses on, and I could see the logo of the restaurant across the street from the eye doctor very well, if I looked at anything up close, it was all blurry. And of course, this is not having worn glasses. This was all new to me. But then when I went inside and I looked at the computer screen, it looked better with these test glasses. But then if I looked at her face, just 6-7 feet beyond that, it was all blurry. I said, "Ooh, I don't like this." So we talked about what lens do you want for the specific application that you're going to use. So we came up with a progressive lens to where it works for reading and it works at the computer screen, and you just look at a certain point in the lens and you learn to focus it that way without having to strain your eyes. So why am I bringing this up? It caused me to think about what lens we need to have when we are in speculative small cap stocks. Now, this is very applicable to junior mining stocks, but it's actually applicable what I'm going to share today beyond just junior mining stocks. I'm going to talk about what is the best lens for speculative small caps. Now, this is not going to be applicable to a lot of bigger companies, but if you're talking about pre-revenue companies that require money from investors in order to develop a big idea of what could be story, this is the ultimate lens that I think you need to apply to this sector. And it is the lens of leverage. Who has the leverage? Think of it in these terms. And my experience as a private investor in private companies as well as public companies, venture type companies that are small, that hope to be big and successful either at the project level, in resource, or even different companies within the private sector that are trying to develop and grow something. This is the lens that you should apply. And even if you're buying in the open market, you want to understand how the game works. And I think you also want to apply this lens to what you're doing to ask yourself, what am I truly leveraging if I buy this speculative small cap stock? And the corollary or the other side of that is, how am I being leveraged? How am I potentially being leveraged by the people in charge of this company that I'm investing in? I'm Bill Powers. It's Mining Stock Education, and we're talking about leverage and the lens through which we view these speculative small cap investments. Leverage allows you to accomplish something that you would otherwise not be able to obtain. If you're a business owner, you leverage oftentimes the bank's money, other people's money. You leverage employees' time. You leverage employees' talent, and you own that system. And so all the productivity that business or that system creates, you profit from. And that system, if done right, leveraging other people's money, time, and talent, can give you outsized financial returns that you would not be able to get otherwise. If you think about mechanical leverage will allow you to lift something that you wouldn't otherwise be able to lift by yourself. I weigh 182 pounds, yet I can walk out to my pole barn right now, and with my bare hands, I can lift something that weighs 6,000 pounds. Why? Because I have a movable pulley across a steel beam at the center of my barn. And using the chains, it may take a while, but I just pull on the chains, and the pulley system will lift an engine right out of a truck, can lift a tractor tire that weighs 1,500 pounds, and it can put it in the bed of a truck to bring to the tire repair shop. It can lift 6,000 pounds with my bare hands. I wouldn't be able to do that if it wasn't for the leverage that pulley system allows me to have. So you're looking for a leverage setup. If you're going to take the time and put your capital at risk in the junior mining sector, you're looking for outsized returns. So you got to ask yourself, what am I truly leveraging? And the flip side again is, well, these people that are selling the story, how might they be able to leverage me in a way that doesn't benefit me? Now, as I'm alluding to, there's a lot of shady or promoters that you don't want to invest with. But the good side is that even if it's only 10% of those that are out there, those 10% generate so much worth, or as Rick Rule says, utility, that it validates the whole sector. And because you can make so much money with the right people at the right time in the right companies with the right discovery or the right pre-production story or the right tier one deposit that is found and then grows over a period of years. So we need good promoters. If there were not good promoters, then you're not going to see progress. Just think about it. We all live inside. And if you're in a warm climate like I am in the summer, then you're thankful for the Carrier family and that idea of the air conditioner. That someone had this idea, people got behind it, funded it, developed it, grew it. Now it's a benefit to all society. Or what about Hoover and the invention of the vacuum? Choose your big idea. If it weren't for big ideas that promoters promoted and speculators put capital behind, there would be a lagging of advancements and inventions in society. When it comes to minerals, if we're going to meet the goals that governments have laid out, if we're going to meet the society's growing electrification, you're going to need copper, you're going to need all lithium, you're going to need nickel, you're going to need cobalt, you're going to need all the rare earths and so forth. And so in order to access those minerals, there needs to be speculative dollar that's given to promoters to pursue discoveries, to pursue development and increase production. So that's the big idea. But of course, you want to put your money behind the best people. It's promoters' job to sell you the what could be value proposition in order to raise venture capital to advance their high-risk projects. That's their job. And they need to tell you what the company is trying to accomplish. And if you're an investor already in one of these companies, it should be your expectation and requirement of the executives that you invest with that they tell the story and tell it effectively, especially if you are a non-revenue generating or little revenue generating to where the main currency or the main product you have to sell is your share price, your shares. Those executives need to be out there telling the story. So that is their job. And if you're going to speculate in this, this is the waters that you swim in. It is shark-infested waters. And perhaps you've seen the U.S. Navy in some photos of when they have the aircraft carrier or destroyer out at sea. Sometimes they'll just take a break, put the anchor down, and have the sailors just swimming in the middle of the ocean. And sometimes they put a net out, though, so the mako sharks or the tiger sharks in the area don't take a bite out of some of the sailors' legs. And they put that net out around the sailors, so when they're swimming, at least the waters, even though they're shark-infested, they're a little safer. So this lens that we're talking about, as you apply it and you grow it, it's not 100% foolproof, but hopefully this will help you to stay away from some of the sharks and the predators that are out there if you choose to swim in these waters. The worst promoters are those that take virtually no risk, yet want all of the reward. They want you to deal with the risk while they give themselves rewards along the way and hopefully a big reward at the end if the overall venture actually succeeds. But if it doesn't succeed, they're going to arrange it so that they don't suffer loss, even as you do. So their goal is to arrange the circumstances so that they win no matter what. You take the risk, they take the rewards, and they are devoid of qualms, many of them, about their actions. I was talking to a friend about some negative experiences I've had, and the friend referenced so-and-so having thick skin, and I said, is it thick skin, or is it truly not caring at all about other people in kind of like a sociopathic way? And yes, if you're going to step out and take risks, you do have to have thick skin, especially if you think you see something that others don't see. However, if that's really not your goal in the end to develop value overall and develop value for your investors, then you're probably erring on the side of being more of a sociopath rather than a good leader with thick skin. So how do these promoters leverage? And I'll share you a story of one of my friends that got taken by a very crafty promoter who projected a false image. And this was a failed private base metal company that was supposed to be public years ago. And the owner of the project, who was more of a technical guy, and his backers, they didn't have access to funds, but they believed they had a good project with a good idea. Through a course of events, a promoter got in contact with them and said, I'll raise you the millions you need to go public. I'll lead the uplist. I will backstop it with X amount of dollars. And in exchange, you're going to give me 20% of the company plus commissions on the money that I raise. And this promoter, who was grossly underqualified, was able to get 1/5 of the company under the terms that he would follow through on raising the millions of dollars and taking the company public. Well, he was able to get the project owner to agree to that because he found a wealthy man and was able to leverage that wealthy man's name, saying that they were working together, when in fact the wealthy man had nothing to do on a day-by-day. It was just this promoter who is now leveraging a wealthy man's name. And then when that wealthy man wasn't going to write more checks into this entity, and when this promoter could not find the funds, finally the project owner, after a period of time, took the 20% away, rolled back all those cheap shares, and is trying to advance the project in a different way. But that promoter leveraged someone's name, reputation, projected a false image to get that huge chunk of the company. And like, what's their downside? If they don't succeed, their downside is going to be minimal. However, what about the few guys, including my friend, who wrote one of the checks into this private co that wasn't successful going public? His money's stuck there. So he was out leveraged. And that promoter did a good job getting something for himself, couldn't follow through. The ruse is up. The false image is revealed. The Wizard of Oz is just an old man behind the curtain, and his money is stuck there. So that's an example of the promoter leveraging and then failing, and the money is just kept there. But other promoters try to leverage up in the same way and do successfully go public. They do so through the obvious way. You can't beat them in the cap table if they issue themselves a bunch of cheap shares that are free or nearly free. This is the Vancouver model. Also, nice salaries with options. Sometimes those options can be reset. If it's a down market and they issued the options at 70 cents, maybe they're going to reset them after the share prices fall into 12 cents. I should note, whereas I may be emphasizing some of the negative, there is the positive necessary side to this also, in that if you're going to have employees, you do want to incentivize them. So if it is a corporation with employees that are working hopefully on the behalf of all the shareholders, you do want incentivization options out there. So I'm not saying it's always bad, but like when you're in control of the treasury and you're in control of the board, I've seen it more than once to where the decisions that are made are in favor of the people in control, not necessarily the equity holders. And so they could be getting paid whether they develop you true value. You could continue to pay yourself on a develop. I've seen this for having been in the sector for a decade now, to where people pay themselves a nice salary and the project is forever at PEA stage, or the project is forever at PFS stage, year upon year upon year upon year. But every month they get direct deposited their checks. And then every 18 months or 24 months, they have to go back to the market for another dilutive raise. Well, this whole time, these promoters are cashing the checks. And if they don't have a lot of skin in the game, if they didn't invest a lot of their own capital or their relationships, or brought something that they'll feel the pain of loss if it doesn't work out into this deal, then they don't have a motivation necessarily to move the thing forward. And in fact, the change of control fee that they could get some point down the road, that could be worth more to them than their equity stake. So they're not aligned with you. And so you're being out leveraged in that sense. A friend recommended I look at a certain company recently last month. And as I was just going down a bunch of rabbit holes, I got onto one executive, and then you follow their insider filings, and you see that they're involved in 3 companies. And I already knew this manager was involved in multiple companies, 3 companies at the same time. The total cash he's being paid per year was $1.2 million from 3 different companies at the same time. Now think about it. Maybe you're a hiring manager, as I used to be when I ran a construction company. Somebody comes to you for a new job, and you say, what do you do now? You want my job, it's 45 hours, 50 hours a week during the peak season, at least when the way I ran a construction company. And if they came to me and they said, well, I already am working 40 hours a week on the second shift at this, or the third shift at this factory, but then I'd like to work another 40 hours a week for you, of course I wouldn't hire them, right? But there are literally executives in the sector that are taking 3 full-time salaries in the 7-figure range, cash, at the same time. And what are they really doing? You got no drill program, or minimal, but you got exploration managers on site, supposedly. Like, what are you doing to earn 400 grand a year from this company and that company and that company? Are you working 120 hours a week? Of course they're not. They're probably not even working 10 hours a week. But those are ways in which they transfer wealth from investors to themselves, and they're going to win no matter what. We're applying the lens of leverages. What are you truly leveraging? How might you be out leveraged? And so your money funding their salaries and ideas is a way in which they leverage you. But if you're going to agree to that, you better make sure that you are leveraging something in exchange, and that there is a potential high upside or high probability of success laying before you. And I'm going to get to that here at the end. And sometimes it's your influence put to work for them. I rejected an opportunity to invest in a seed round of a United States-based energy company. They approached me. This was like a year or 16 months ago or something like that. And the allotment they were offering me, I brought in one of my friends and said, let's look at this together. Whatever allotment they're offering me, if you want it, you can have half of it. 2 eyes are better than 1. And as we were talking through the idea for this energy company wasn't that compelling. So I wasn't inclined to move forward in that call with the chief executive. And then when we were asking for clarity on the cap table, we're offering you a certain percentage of the company. And we're like, okay, well, how many more raises before you go public? Well, at least 2. Okay, so there's going to be 2 more dilutive raises. So basically, giving me a chunk would be basically signing me up to fund the company twice more, and probably hope that I would share the idea with others in my network to where they would write checks. So basically, it was just trying to leverage me for money. And it's not wrong. Again, you need promoters to do that. But what wasn't disclosed until we got asking questions was, okay, if it's this percentage of the company, what options are out? And they loaded themselves up as founders with so many options at, a negligible strike price, that when you did a fully diluted valuation, what I was offered was less than 1% of the company, which I would split with my investor friend. And then there was going to be 2 more raises before even going public. So they gave themselves too much of the company. There wasn't enough left there for investors. And so they were looking for other people's money and other people's influence to fund their upside. And I took a pass on that one. When you want to think about how might you be taken advantage of, think about your leverageable vulnerabilities. And when I think back of where I've missed it in this regard, greed has been a factor to where I've focused on the blue sky potential, the what could be, without true regard for the risks. Also, ignorance, and even beyond the mining sector, when I've invested and even spent money and time doing due diligence, as in weeks, where I've missed the mark and didn't get the return I was looking for, it was when I didn't know the business well enough. Pride, thinking you know more than you do, or thinking because I was successful in the past, I'll be successful again. Sometimes it was laziness, and this happens in a bull market, and I've seen it multiple times in myself, to where you confuse a bull market with brains. You just come off a big win. You made so much money so quickly that if you're not careful, you'll get too loose with your money, and then you'll throw that money at bad ideas. And sometimes you're deceived. You're presented with false and misleading info. And what you do with that, there's not a lot of recourse that I've observed, at least in the Canadian venture markets, that you can do some pretty shady shenanigans, and there's maybe a slap on the wrist, but it's a small percentage of usually what the promoters behind the idea make as a result of running the sham. And so I've had it where promoters that are raising money talk up the guy in charge, and they build him up. They say he's a genius. In one company I was involved with, the lead mouthpiece was like, this guy's a genius. And I would talk to him. I'm like, okay, well, he's not unintelligent, but I don't know if he's genius level. And then after a period of time when things weren't working out, one of my business associates ended up meeting the guy that fired him from one of his previous corporate jobs. But when I got the bio from the exec, he talked about his work there with that particular company as that was like a notch in his belt or something he could be proud of on his resume. But he actually was let go for some of the things that then caused the current company he was in charge of to not work out so well. So you want to think about, I've talked about a lot of the negative ways in which you can be leveraged, but you want to think about what you can leverage, okay? So the first thing is access. How do you develop access? We're going to talk about this, and you may be saying, well, I just buy in the open market. Listen, I'm going to explain the game the way it is. So even if you only buy in the open market, you want to understand the waters you're swimming in. You want to understand how the game is played. Money. You see the big guys in the resource sector, they leverage their money for a good deal. Knowledge. And if you're buying in the open market, when we get to this discussion point and leverageable thing, you really want to be able to say to yourself, what am I leveraging in terms of knowledge and timing, especially in a cyclical market that goes up and down violently with huge fall-offs and then huge roller coaster rides up. You want to get the timing right. These are the four main things that you can leverage. Leveraging access. I did an interview with Tommy Humphreys last year. I can link above and in the show notes. And that was about how to network your way into the deal room. Tommy shares some of his own stories and struggles, talks about how Vancouver works if you're interested in junior mining stocks, and talks about ways the average person can gain access. Perhaps one of the things he mentions in that interview is that in the room, in the deal. How do you want to get close to the best deals in which you might be on the more leveraging side of the equation? Well, in the room, in the deal. And you could say, well, like I'm Joe Schmo listening wherever you're listening, I'll never be close to a deal like that. Well, I'll just remind you and tell you what I was told years ago, that there's three types of people. There's one type that says it cannot be done. There's another type that says it can be done. And there's another group that says, what just happened? I don't even know what just occurred. Okay, so you could be oblivious, you could be a naysayer, or you can be one that says, there are people doing it, I want to find out how they're doing it. And so you can have access to good deals, leverageable deals for yourself via relationships that you've developed, whether online or in person. Talked extensively about this over the years. Mark Zaret last year talked about how crucial it is to do that, and how most of his deal flow comes through relationships, not even just stock screeners or things like that. It's actual relationships and recommendations that he gets from fellow investors that he trusts. And deal flow, because you're a value add to others. If you start adding values to other within the junior mining sector, you'll likely see more deal flow arise. You can even seek out a good broker. And if that broker is known for a good deal flow, you can ask him for some of his last deals. just be aware that every broker usually has a network, and that they'll probably present to you a lot of the deals that come through their particular network, whether they're going to be good for you or not, because the brokers do make commissions oftentimes on a lot of these financing or putting people into these deals. So there's a conflict of interest, but nonetheless, those are ways in which you want to begin to think about how you can leverage access. Now, leveraging money in finance for speculative small caps, the golden rule is he who owns the gold makes the rules. And so if you have the money, you can negotiate favorable terms for direct investment into junior miners. Rick Rule is kind of one of the founders and authors of the 5-year full warrant at cyclical bottoms, financing prospective junior miners. And he does that because he's able to write a check and then bring a lot of his network into a company. So when you have that amount of money, then you can create a good deal for yourself. He gets the 5-year full warrant and also high interest rate debentures. A debenture is a debt instrument that's convertible into equity, sometimes at the option of the debenture holder if they don't want to be repaid in cash. Every debenture is different, but these are some of the very favorable and lucrative financing instruments that you often see at a cyclical bottom. And if you can get into one of these at the right time in the right company, it can be very lucrative. Leveraging knowledge. So the junior mining market is very inefficient at times. This is what creates the opportunity where people don't pay attention to, don't understand the geology, or the team that's in charge of a particular project don't communicate well, and there's not sufficient analyst coverage or online discussion about particular companies because they're small. So it creates inefficiencies in the market, and then you can capitalize on this knowledge arbitrage. What do you know that the market does not widely recognize? That is what you want to ask yourself. This is when we're talking about knowledge arbitrage, or the ultimate thing that you need to be thinking about. What can I leverage? Especially if you're only buying in the open market, this is it. What do you know that the market does not widely recognize? What is your advantage? I've been watching with my son, who's interested in investing, these documentaries on card counters and people that go around the country playing blackjack. And they use card counting to try to determine when the probabilities are in their favor. So it's basically just a good memory with math helps you determine the probability of when you're looking at your hand, your competitor's hand, the dealer's hands, knowing what cards have already been dealt. You're thinking in terms of the probability of if the next card, would it be in my favor to perhaps give me the winning hand? And it's not a surefire thing. You don't always win. But if you employ this, it tips the probabilities in your favor. So that's where you gain the advantage. And the casino arranges the situation so that the house always wins no matter what. And if they detect that an advantage player is getting the upper hand, then they remove that advantage player from the casino. When that advantage player is not doing anything illegal, they use the private property laws and say, hey, you're trespassing. We're not accusing you of anything wrong, a crime, but we noticed in observing you that you are an advantage player. You're card counting, and now you're beginning to win. So we no longer want you on our private property, and they remove that player, and they often will alert the casinos in the area of this person. So these advantage players sometimes have to disguise up and stay on the move, even across the country, to try to find new casinos that won't recognize them as an advantage player. Sometimes it works well, applying the card counting method. Sometimes it doesn't. Even when you apply the method, you don't always win. And isn't that junior mining? Even when you think you've found an advantage or the ideal setup, it's not a 100% guarantee that you're going to win. But at least when you speculate, when you leverage that knowledge, you know that the probabilities are in your favor in that situation. So that is the setup that you're looking for. So where would some leverageable knowledge come from? Maybe insights from your network. Now, this last year, I hired a couple of geologists and analysts actually to look at some investments and some projects for me, and I purchased from them a written report. Rick Rule told me that if he's going to put $1 million into a private placement, he might spend $35,000 hiring technical people to look at that prior to putting in $1 million. So that's 3.5% of his investment. And I did some of that this last year just to get different insights. And it's kind of interesting when you have different eyes looking at a project. They come up with different strengths and different potential weakness points. So you can talk to professionals, you can talk to fellow investors. You should be talking to the executives yourself. You can talk to some of the other executives that are in that same geological region as the company that you're thinking about investing in is, or you could talk to people that know that executive and ask for referrals. Like, what insights have you developed a network? And if you haven't, that's the problem. You're not going to be able to have as much knowledge to leverage. But if you have, how are you leveraging the insights from your network to determine if you should be putting your money into something? And then you want to speculate in asymmetric risk-reward setups. It's still risky, but you want to make sure that if you're right, and there's a significant probability that you could be right, that when you are right, you're going to get a substantial return in exchange for the risk that you took. It could be a post-discovery drill play. There's a lot of people that specialize in that. You could be good at identifying pre-production ramp-ups with good teams that can actually build the mine, the Montage Gold, the G Minings in the last few years. Maybe it's a tier 1 deposit. I've noticed, having been on Twitter for 9 years, that people were talking about certain tier 1 deposits, and years later, that's a 25x on some of these. And it's kind of been interesting to just watch people talk about the stock as it goes up 25x over 6 to 8 years, because that's what tier 1 deposits will eventually do. Or maybe it's a growth-oriented producer where you've identified a growth profile, a significant probability of success that other people haven't. So what knowledge are you leveraging? And then you can leverage timing. Maybe you've identified a decent opportunity where management is highly incentivized. They've funded the company with their own money, and the stock is trading below their cost basis. That might be a good timing indicator. And then you have to identify the cyclical or seasonal low. The seasonal low that occurs usually in tax loss selling season in December, and then the overall cyclical lows of a given commodity or the mining sector in general. Leverage timing, investing after the company is financed, cashed up, in pre-catalyst, where there's things that could move the share price on the horizon that are very clear for the eye to see. And in regards to timing, I'll just say this too, patience for the right scenario, that money is made over periods of time. And yes, you date and don't marry, you rent, you don't buy mining stocks is the saying. And that's true on the one hand, but at the same time, on the other hand, if you have a good deposit in the hand of good people, patience, there can also be wisdom in that. Rick Rule's famous saying that he never had a 10-bagger that didn't fall by at least 50% at least once over the period in which he held that stock. So you do want to have patience. We're talking about the lens to apply to speculative small caps and junior mining stocks. And again, the lens that I'm giving you today, the main lens would be, what am I leveraging, or how am I being leveraged? View it through the lens of leverage. And if you have people coming to you asking for money, like I do and others, this is the lens that I apply. I want to thank you for your listenership. I'm Bill Powers, and I'll catch you on the next one, and I wish you the best in your junior mining speculating endeavors.